Hello, everyone. Hello. I think we're going to get started here. In an environment where headlines shift by the minute and economic and tax policy is anything but certain, clarity has never been more important. That's what today is about. Cutting through the noise and having a real conversation about what's taking shape in Washington and what it means for all of us. Good afternoon, everyone. My name is Matt Beardwood, and I'm the Director of Wealth Management for Westover Capital Advisors. I have the privilege of leading our wealth advisory team in delivering personalized financial advice to our clients. And on behalf of our entire team, I want to thank you for being here. I want to make it an especially important welcome for all of our clients and our close Westover friends. Your continued trust and support is why we do what we do, and we're an honor to be part of that journey. For those of you who may not know us, Westover Capital is a boutique wealth management firm headquartered here in Wilmington, Delaware. We work closely with high net worth and ultra high net worth multifamily generational families, business owners, and foundations. And our goal is really simple. It's to bring clarity to complexity and help you make informed financial and confident decisions with your wealth. We offer a full range of integrated services from investment management, financial planning, tax strategy and preparation services. We also provide retirement and estate planning services and family office services, among many others. And our team includes professionals with deep expertise and industry-leading credentials, including certified financial planners, a chartered financial analyst, a certified public accountant, and a Juris Doctor, each bringing a unique perspective to our work with our clients. If you want to learn more about us, visit us at westovercapital.com. For 13 years, Westover has hosted this summit and invited an expert voice to lead a discussion that gets to the heart of the matter. And this year's no different. We're thrilled to welcome Daniel Bunn, President and CEO of the Tax Foundation, for what promises to be an insightful discussion. Daniel is a leading voice in international and domestic tax policy and advises policymakers around the globe. He's regularly featured in major media and trusted across the aisle for his nonpartisan, objective insights. The Tax Foundation, founded in 1937, is the go-to source for accurate, data-driven tax policy and is known for cutting through the rhetoric with clear, facts-based research. Each year, the foundation hosts its signature gala event, affectionately referred to as the Tax Prom, I think it is?
Yes.
Okay. The Tax Prom honors individuals who have made notable contributions in the field of tax policy. And here's a fun Delaware connection for you. It was 30 years ago that Senator Bill Roth received this foundation's Distinguished Service Award. Senator Roth was pivotal in shaping the Taxpayer Relief Act of '97, creating the Roth IRA, which we all know. And on a personal note, early in my career, I was fortunate to work with Senator Roth as a legislative aide right here in Wilmington, Delaware. And it's an experience I still value today very much. So Daniel, welcome. We're glad to have you here with us today.
Thank you for having me.
I'd also like to recognize my colleague and friend, Chip Sawyer, who will lead today's conversation. Chip is the Chief Investment Officer and the person who leads the investment strategy and research that powers Westover's portfolios. He also works directly with many of you on protecting and building your wealth across generations. Chip has more than 25 years of industry experience. Prior to Westover, Chip served as the principal research analyst at Tucker Capital Management. And before that, he was the lead equity trader at Jurica and Voiles, a multi-billion-dollar investment management company in Oakland, California. He holds a bachelor's in psychology and an MBA with honors from the University of North Carolina at Chapel Hill and is a CFA charter holder. So thanks, Chip, for leading this conversation today with Daniel. And so with that, I'll turn it over.
Thank you, Matt. And thanks again to all of you for joining us today on this beautiful sunny day.
Daniel, we're very excited to have you here, especially with what's proving to be a very interesting year in terms of tax and tariff policy. Before we start, I have to tell a quick story about my preparation for this event. I had the terrible idea that I should start with a joke, and not surprisingly, I don't have a lot of tax policy jokes. So I thought, well, I'll ask ChatGPT. And for those who don't know, ChatGPT is OpenAI's artificial intelligence interface. It's an incredible tool, very powerful. It can help you write emails, create itineraries, and it does everything really quickly. So I went to ChatGPT and I got the prompt and I said, tell me a tax policy joke. And the thing just sat there. The cursor's blinking and blinking, and finally it came back with this answer and it said, internal service error. And so apparently I crashed ChatGPT by asking for a tax policy joke. So
one of my challenges with tax prom every year is coming up with jokes to tell a tax prom, and it's I always collate them from my staff,
that's
and
good.
it's always a little iffy whether we might get jokes or not. More often the laugh is at the fact that somebody tried to tell a joke about taxes than the actual joke.
That's pretty funny. Considering how the market's been behaving over the past few months, I should say, I'm much happier to be talking about tax policy than market returns or tax jokes. So with that, let's get started. And I'm going to start with what's on top of everyone's mind these days, and that's tariffs. I don't know how much of the Tax Foundation's time was spent thinking about tariffs before President Trump was elected, but I imagine you spend a little more time on it now. So what are the economic and policy implications of the potential tariff adjustments for U.S. businesses and consumers?
So tariffs have been part of our work since late 2018, when the Trump administration first began a wave of the trade war that continued through the Biden administration and now has ramped up to levels that we absolutely did not anticipate back in 2018. The economic impacts of tariffs are difficult to evaluate if you don't have a clear appreciation of how integrated the US economy is with other economies. And one of the things we've been building over the years is a modeling tool that allows us to capture the cost increase through supply chains to be able to say, okay, this is going to hit capital intensive industries, this is going to hit consumer wallets, this is going to hit on down the line with hiring decisions, investment decisions, and things of that nature. Where the policy sits today, who knows what it will be tomorrow or next week, but where the policy sits today, we see this, if it were to stay in place over time, this is a multi-hundred billion increase in US revenues through the channel of additional tariffs paid to the US government, and a nearly 1 percentage point hit to US GDP over the long term. Now, when I talk about the long term, this is kind of a really tough constraint to deal with all the uncertainty and turbulence that we're seeing in the policy debate, because usually when economists try to model things out, you have to think of what particular state the economy might be in if this policy doesn't exist at all. And most models, including our model, is a long-term model. So you think of the long-term state of the economy without the particular policy change, and then you throw the policy change into that and the details that you have, to the extent that you're able to collect details on them, of the US economy and where these different pieces fit together. So you measure what you expect the long run state to be, and then you adjust for the policy, either upward or downward. And then you are able to get some of these impact assessments, like what I just said, nearly a 1% long run hit to GDP. The trade-offs, as we've been identifying for quite a long time, are not in favor of long-run US competitiveness or US growth. The president is very clear on his intentions to use tariffs as a revenue-raising tool, potentially to replace the income tax, which the math doesn't work on that. But the alternative piece that he and his Treasury Secretary and his chairman of the Council of Economic Advisors are pointing to is the potential for reshoring investment, reshoring manufacturing, building up the US economy in a different way than we have right now. And the challenge with the tariffs being the tool to accomplish that goal is that even if there was an opportunity to reshore manufacturing, and a lot of companies have considered this over the course of years since the corporate tax rate came down in 2017, there are still significant inputs that US manufacturers use and source from all over the world. And to say, well, we're going to hold these tariffs in place until you reshore is like saying, well, if you can bring back your manufacturing to the US, but we're going to put higher costs on you until we think there's sufficient levels of reshoring or sufficient adjustment from our trading partners. And it's not clear at all to me how that's going to work in favor of additional US investment, either by US-based companies or foreign multinationals considering whether to invest in the US economy. So at the end of the day, the challenge is, and the results that we get from our model, is that US-based manufactured, US-based production is going to see increased costs, and increased costs will turn into higher costs for folks in their own consumption patterns, and higher costs for hiring and investing in the US. So it's possible that we see a pivot in the next week or so. I feel like every day there's some new story about what the next element of the strategy is going to be, where there are opportunities for trade deals or not. Maybe we talk about trade deals at some point, but at this point, what we're looking at in the economic impact is generally negative across the board.
And related to that, so you talked about two major goals that Trump has for this tariff policy, and that is bringing back manufacturing jobs and raising revenue. Is there any talk in Washington about using the tax code to accomplish those goals rather than this tariff policy?
Yeah, so the discussion around reshoring investment and investing in US manufacturing has been a bipartisan conversation for decades. The policy tools that were kind of front of mind for that effort were more on the tax side than on the protectionist side. There's been bipartisan support for protectionism on the steel industry and different other sectors, shipping industry and things of that nature for quite some time. But the efforts on increasing competitiveness for new investment those efforts were focused more on the tax code. And there's two pieces of US tax policy that usually come up in these conversations. One is just generally the US corporate tax rate. And where we are right now is roughly middle of the road with other large developed countries. 21% US corporate rate is fixed permanently in law, permanent, subject to for future congressional action. But when you combine that with state rates, the average brings you up to close to 26%. So if a company's thinking of investing in the US, they look at our peers in the developed world, and they may say, oh, okay, we care about the 21 because we're going to be in a low tax US state when we invest, or they may look at California, New York, and see the effective rate be much higher. The other piece of the puzzle is the tax base. So anytime you have to pay taxes, you have to come up with your income. And the US tax code has dozens and dozens of ways that it determines income. One of the things that we have talked about at Tax Foundation for many years is that for businesses that are making capital investments, businesses that are growing, that you have to make sure the tax code correctly treats the costs of those investments. There's a mismatch between the way tax code thinks about the life of investment and the deductions and the real net present value of those deductions. So we talk at Tax Foundation about full expensing for capital investments. And this is an item of bipartisan interest and will probably be part of the tax bill we see this year. But it says to businesses, if you invest in capital equipment, you can immediately deduct that cost rather than having to spread that out over the useful life of the equipment or piece of machinery, or even potentially a factory or other piece of real property. The challenge with that policy is helping policymakers understand sort of just simple net present value calculations. Because if you have the same deduction spread out over 10 years, I think everyone in this room would know that inflation and the real the time value of money would impact the value of that same deduction 10 years from now rather than here in 2025. So what we've been doing is educating policymakers on the value of that policy for U.S. investment and U.S. competitiveness for investment. So combine the corporate rate with some of these changes to the corporate tax base, and you're able to pretty effectively show how those policies can support efforts to reshore and invest in U.S. manufacturing. And again, these are, there's, I would say, some partisan differences over the corporate tax rate, significant partisan differences over the corporate tax rate. But when it comes to the base and some of these pro-investment policies, you see policymakers across the political aisle notice and note the value of some of these things like full expensing, immediate expensing for capital investment.
How is the shifting economic outlook influencing the policy discussion right now?
So late last year, there was a discussion I was involved in with some policymakers, and the discussion was around the size of the fiscal package that is being debated this year. So the Tax Cuts and Jobs Act from 2017 has an extension cost. It would increase deficits if policymakers chose to extend it beyond its expiration date at the end of this year. And policymakers were thinking, well, maybe we can just do this, markets won't care. Markets may already assume that this extra $4 to $5 trillion is going to be in our deficits going forward. Markets are comfortable with that additional level of Treasury issuance. And in that discussion, I and some others were saying, hey, it's never a bad idea to think about how you might react if the market decides it's not comfortable with additional levels of US debt or something else is happening in the markets. And that it would be really important to think about a level of offsets, spending offsets, other revenues that could make that package a little more palatable, especially thinking about the bond market. Where we are today is, instead of me and a few others trying to seed that conversation with policymakers are coming to us and saying, hey, is this what you were talking about when we were saying that maybe there should be some right sizing of this and maybe the markets would actually care about Treasury issuance and the level of US debt? So there's a lot of nervousness on Capitol Hill right now in two respects. One is nervousness that, from the Republican side of the aisle, that if they don't get this policy mix right, they lose the midterm election and potentially horribly. Right. I'm not a political analyst, so horribly is a layman's term. Not expert analysis there. So they're trying to figure out how to get this policy mix right because they feel like their political future hangs on it. The other thing that they're worried about is not political, but is what we're seeing in the markets, and thinking, what if there's a way to shape spending and tax package that would calm everybody down and get things kind of back on the right track? And the answer that I've had for them is, well, the issue, two of the issues are, one is the tariffs that we've talked about already. And the other is just the level of uncertainty that comes with the way the administration is talking about its own policy objectives. And that's not something that Congress can necessarily solve. That's something that the White House has to determine what's the future of the tariff policy and whether they're going to name specific objectives that would shift that policy. So the economic environment is creating a lot of questions, a lot of nervousness, and I think creating a little more pressure for Congress to act quickly on the tax and spending package.
What's your best guess on where we end up on the tariffs? Please tell me. Please, I really want to know.
Here's the guess. So I really do think the 10% universal tariff is there, and that I really doubt the president is going to move off of that. I think everything above that for all countries other than China will probably go away. It's likely that we move down to 10% for all countries other other than China. And I would like to say that eventually the tariffs on China are, lower than 100%. But that's where I feel the landing spot is for this administration, because Trump has been talking for years about his universal baseline tariff. And I think he is one of the few people, one of those policymakers who is like, once he has decided something and has been talking about it for as long as he has been, it'd be very hard to move him off of that point. Very hard for him to see a face-saving opportunity if he were to move off that point. Maybe he's able to blame Peter Navarro and say, well, it was his idea all along. Now he's fired. 10% universal tariff is no longer there. I don't know. But I feel like 10% universal tariff is probably there for at least this administration, and then the tariffs on China are a different story. The thing, and we talked very briefly about this before I came up here, is there are a lot of legal challenges to these tariffs being developed. It's not clear how quickly we will see rulings on those, and it's also unclear how the administration will respond to those rulings. It's a lot of open questions, and again, not my area of expertise.
Right. So initially, the optimist when Trump was first elected, in terms of the tariff policy, was okay. He's going to use these as a negotiating tool, and somehow it's going to lead to all tariffs coming down. But you're saying the chances of that are pretty slim at this point.
I think so. The reason for that is, if we are going to reduce trade barriers with other nations, there is some opportunity for unilateral reduction of those trade barriers. Plenty of opportunity. We saw this leading up to the April 2nd announcement, with some countries saying, hey, we're going to stop all tariffs on the US. Israel was a country that unilaterally stopped tariffs on the US. That did not give them an escape route from the announcement on April 2nd. But there's discussion of maybe a US United Kingdom trade agreement, a US Japan trade agreement. And trade agreements aren't things that get negotiated quickly. And usually they are paired with a special process on Capitol Hill, where lawmakers on Capitol Hill give the administration sort of a leash that says, hey, we want you to go out and negotiate trade deals. These are the things we want to see included in those trade deals. And if you come back, if you work with us over the course of your negotiations and come back to us with an outcome that fits those priorities that we put in this legislation, then we can process those very quickly. It's something called fast track. That's what folks on Capitol Hill refer to. It's Trade Promotion Authority, but the shorthand is fast track. Fast track expired during the Biden administration, and I do not see any momentum to adopt or reintroduce fast track for this administration. It's a time-limited thing. Usually you give a president 4 to 5 years worth of fast track authority, and then you expect for the negotiations to work out in that timeline, and then you're able to pass a free trade deal through Congress in an efficient manner. This is what was used, if you remember back in the early 2010s, there was the Trans-Pacific Partnership and the Transatlantic Investment Agreement or something like that. But those two were negotiated under fast track authority that Congress had given to President Obama and Ambassador Froman at the time. And when they were ready to be dealt with, the politics had completely shifted and Congress wasn't interested in adopting those. So this idea that, raising tariffs significantly can lead to trade deals, it'll take a while for that to work out. There might be some jurisdictions similar to Israel that are willing to do unilateral reductions in their trade barriers, but that's not what you're going to get out of the United Kingdom or Japan, some of our much larger trading partners.
Let me shift to personal and corporate tax policy. What significant tax reform proposals are currently gaining traction in Congress, and what do you view as the most impactful for individuals and businesses?
At the end of this year, the tax cuts from 2017 will expire if Congress doesn't do anything to extend those policies. So that means the rates and brackets that you're working with for, you just filed your taxes for 2024, those will dramatically shift. And 2017 brought rate reductions across the board, brought in a larger standard deduction, brought in some other changes on the personal income tax side. We see a lot of debate about the cap on state and local tax deductions set at $10,000. All of that will expire at the end of this year if Congress does nothing. There are some things on the business side as well that could expire. So pass-through businesses that have been able to benefit from the 20% deduction, that is also set to expire at the end of this year. And there's some corporate provisions as well. So when we're talking about big proposals, just about everything that is being talked about right now is how is Congress going to extend most, if not all, of these policies beyond the end of the year. Now, one of the tricky elements of this is that Republicans like to talk about tax cuts. And we've done some polling on this, others have done some polling on this, and people, the average person says that, keeping tax rates the same isn't a tax cut. So for the president to have campaigned on tax cuts and for Congress to be really looking at how difficult it might be just to extend current policies, there's going to be some sweeteners to the deal. And they're not necessarily sweeteners that I approve of, but they are certainly things that the president cares about and some members of Congress have decided that they are also going to care about. And those are things that affect tipped workers, overtime workers, folks on Social Security. There's potentially a special deduction in all three categories where you get some sort of deduction for tips if your earnings are through tips. I'm not sure how they will write the rules on that. Again, I'm thankful I'm an economist, not a lawyer. Overtime, similar story. When it comes to Social Security, I'll note that President Trump likes to say he would like to exempt Social Security from taxation. And the chairman of the Ways and Means Committee, Jason Smith, likes to say he would like to give seniors a tax cut. And I'm not sure, I'm pretty sure there's a substantial difference between the two, because if you are eliminating all taxes on Social Security, that is a policy that cannot be done through the budget procedures that policymakers are looking at right now. There are some budget procedures that don't let you touch Social Security, don't let you change how the trust funds are treated and things of that nature. So that's almost completely off the table. But you could create a special deduction for seniors that allows them to kind of save face and say, well, Mr. President, we gave you your tax cut for those earning Social Security. Another big proposal that's in the discussion right now on the tax cut side, and this is something that Tax Foundation's been working on for years, and it's related to the full expensing idea I mentioned earlier. Currently, most of the time when you see policymakers talk about full expensing, they talk about equipment, short-lived assets, mostly assets that have lives less than 15 years, almost never talking about structures. And the tax code has a 39.5-year timeline for deducting new structures. And recently we've heard policymakers speaking positively about creating some sort of bonus depreciation for structures or accelerated depreciation. Maybe not quite immediate expensing, because that could be a pretty big hit to revenue, especially in the transition phase in, but it would be a pretty powerful economic tool. There are some other proposals about tax increases. You may have seen the news over the last week or so about Republicans considering raising the top rate to 40% or letting it just go up to the old 39.6%. I don't have a lot of confidence that that will actually be in the package at the end of the year. There's a lot of House versus Senate distinction here. So there are some very populist members. There's populism on both sides of the Capitol, but I would say there's some more populist members of the House that are very interested in increasing taxes on businesses and higher earners, that I think those policies, those proposals would be dead on arrival in the Senate. At some point, they have to figure out their differences and what stays and what goes. But that rate increase is certainly something that I was not really surprised by when I saw it pop up in the news, knowing how some of these members have talked to me about, wanting to stick it to different parts of the population, and me thinking, guys, wait, are you making policy or political points? And I think many of them are just interested in political points.
Right. So what are your best bets on where we end up on SALT? Any changes to capital gains or state and gift tax laws?
Yeah, so SALT, I think it's almost guaranteed there's going to be some increase in the SALT cap. It could be doubling it to 20K, could be moving it to 25K. The thing that I think will likely be paired with an increase in the SALT cap is some return to the old alternative minimum tax, which indirectly capped state and local deductions. So I really am not sure where policymakers will end up, but some of the conversations that we've had suggest that staff and some of the members are thinking in that direction. So it's going to be one of the things that is very hard to figure out on first read of the legislation. And one of the things Tax Foundation values in tax policy is transparency. And I think this is one of those areas that I think lawmakers are really going to try to hide the ball. I think members of the so-called SALT caucus, these members of Congress who have said that there has to be some relief for taxpayers who are capped with the state and local tax deduction cap, we'll probably see through a little bit of that, but I think there is going to be some relief there. On capital gains, this is an area that I expect very little to happen. The president has identified carried interest as something he wants to see hit in this process. It was something that was on his wish list back in 2017, and Congress just ignored him.
Why is that always so hard to get through?
So it's hard to get through for two reasons. One, the juice isn't really worth the squeeze from a revenue perspective. Right. So if you want to add that in, like, you're going to see all sorts of the carried interest lobby show up at your doorstep, and for the 60, 70 billion over 10 years, it's probably like there are bigger fish to fry.
I gotcha.
To mix metaphors on purpose.
So
that's one of the reasons it's really hard. On a state and gift tax, I think there's some reason for optimism here, because one of the policies that would expire at the end of the year is the higher estate tax threshold. Senator John Thune, the new Senate Majority Leader, is probably if not then very close to the top Republican opposed to the estate tax. And I'm certain that he will exert leverage to make sure that that at least the current level and adjusted levels of the estate tax exemption will continue in law beyond this year, if not further broadening those exemptions. There are some interesting wrinkles to this area of policy, because there is a growing dissatisfaction both from the president and from many, I would say, Republican and Democrat lawmakers of the way that gifts to endowments are treated and endowments themselves. So to the extent that people have in their estate plans, a certain gift to an endowment or some foundation, charitable organizations, tax foundations, a 501c3. I love it when people choose to include us in their plans. But the trick that may come through is a tightening of rules for some of those distributions. I have no idea on what that actually looks like. I have certainly seen the sentiment rising as far as concern among lawmakers for some of those distributions. And then secondly, the endowments themselves have been facing an excise tax since 2017, and I really expect that endowment tax to go up significantly in the legislation. So depending on where you think, estate, gift tax, all that fits together, I feel like the endowment and the 501c3 bit somehow, fit in there a little bit.
Okay. Let's switch to corporate tax. There's an ongoing debate about appropriate levels of corporate tax rates. Where does this discussion currently stand, and how might it impact the broader economy?
So
There's also talk about the global minimum tax rates.
Sure. Yeah, so since 2017, when the US corporate tax rate moved from 35% to 21%, there's been a wide-ranging discussion worldwide about corporate taxation. There was concern, I think, primarily from leaders outside the US, but there's certainly a US element to this discussion about what is called the global race to the bottom on corporate taxes. From my perspective, the US was moving towards the middle. A lot of people said a 14-point rate cut is a race to the bottom. I don't think the US corporate tax rate's going to zero anytime soon. There would be a lot of revenue consequences to that, but certainly identifying some of the tax competition around the world, the Singapores, Switzerland, Ireland, those jurisdictions, the way they've been able to navigate the global economy and use corporate taxes as a tool to attract investment. For a large economy like the US, the corporate tax is a tool for attracting investment, but it's not really the only game in town. We've got a large market, we've got an educated workforce, we have fantastic infrastructure, and the difference for the US is seeing how the corporate tax fits in with all those other pieces. I think it's critically important that you get the tax base right, as I've mentioned before, but the level of the corporate tax rate matters a lot, especially for, I would say, large multinational businesses. So when large businesses are thinking about their earnings and their profit distributions and things of that nature, the corporate tax rate is really the only game in town. Certainly expensing helps the smaller businesses and growing businesses utilize their cash flow to invest in their own products and footprint. But for larger companies, they're really focused on the corporate tax rate. So when the corporate tax rate came down, you immediately saw companies adjust what they were planning for buybacks, what they were planning for maybe an additional dividend here and things of that nature. If the corporate rate were to go up, you would see the opposite behavior, and you may even see some anticipatory pullback on some forecasts and things of that nature. Where the debate is in Congress, I think that 21% rate is here to stay. It's one of those things where if anybody wants to move that rate up, they're going to be the first person that everybody looks at and says, oh, it's his fault or it's her fault. They're the one that's making the case for this thing. And nobody wants their name attached to a true corporate tax rate increase. On the Republican side of the aisle. On the Democrat side of the aisle, during the Biden administration, there was live legislation for an increase in the corporate tax rate that the Democrats were not able to get over the finish line during the Build Back Better debate, which eventually became the Inflation Reduction Act. And that's something that I was surprised at. I thought there would be Democrat votes for increasing the corporate tax rate, especially after a lot of the concerns that were identified from that side of the political aisle after 2017. But right now, I think we're in kind of a stasis on the corporate tax rate. It's easier for policymakers to kind of let that lie and deal with other things, either in the corporate tax base or in different excise approaches, than to just increase the corporate tax rate. There is a lot of discussion in corporate tax policy on the Republican side of the aisle right now, though, to increase corporate tax revenues by indirect means. So the state and local tax deduction cap that's in place for individuals, there's been discussion this year of creating some sort of cap for state and local tax deductions for corporates. So if you're a corporate, you pay your state and local taxes as individuals do. The formula is very different. More often you're paying the footprint of your state and local taxes align with where your customers are more than maybe your manufacturing footprint or your headquarters footprint. But if that were eliminated, that would be, in our perspective, tantamount to a corporate tax rate increase. You might get 2 points on the rate if you disallow corporates from deducting their taxes that they pay on their corporate income in states. And another policy that we've heard rumors about it, but nobody has raised their hand to say that they are the ones starting these rumors, is a policy that was adopted in several years ago, but it limits the deductibility of executive compensation. And for businesses that have executives that are compensated above $1 million, there's limits on what companies can deduct. And the rumor that's going around is that policymakers are debating expanding that beyond the C-suite and saying, well, there might be a level of income at which companies are not able to deduct the salaries that they pay their workers. And to me, that's a really, really challenging proposal, because what you would see is a fracturing of the C-suite, a fracturing of highly compensated employees almost immediately. The different contractors or different consultant shops would immediately see opportunity for them to claim highly compensated employees, and then the businesses would be able to deduct contractor fees rather than employing people directly. Again, this is a rumor where nobody has yet raised their hand and said, I think this is a good idea and I'm going for it. But it's one of those things in conversation where somebody says, hey, have you heard about? And I'm like, yeah, who did you hear from? And the circle kind of goes around. But it's one of the more problematic policies in corporate tax policy that I've been paying attention to over the last couple months.
Any other policies that aren't getting enough attention?
So I've mentioned a few already. Let me go back to the nonprofit side of things. So one of the things, and this is something that Tax Foundation has focused on for a number of years, and we kind of talk against our own book in this because we are a 501c3, but the charitable section of the tax code does not necessarily serve the U.S. very well. There's plenty of charitable entities, nonprofit entities, that compete with for-profit institutions. You see this primarily in credit unions and hospitals, and even in the sports arena. So nonprofit sports entities that are competing with for-profit sports entities, nonprofit hospitals competing directly with for-profit hospitals. But the credit union space is another one. And there's this piece of the tax code called unrelated business income. And nonprofits that earn business income face a tax on their unrelated business income. And the discussion right now is, and this is something that we tried to put into the conversation over the last several years, is to rethink those rules. Because it doesn't make sense from a market economy standpoint that you would have major tax preference over here, this competitor, against somebody who is fully taxed under the tax rules. Now, that's the kind of academic angle to it, but there is certainly a political angle to this where the endowment tax, even the discussion that we've seen in the news over the last couple of weeks about the questions that the Trump administration has raised about Harvard's tax-exempt status, there's a level of this that turns into, well, we want to use the 501 section of the tax code for political purposes to identify the groups that we don't want to have charitable status versus those that we do prefer. So there's, from a policy perspective, I think there is real justification for wading into the rules here, but the political angle, I think, might be what wins the day.
Okay. I'm going to ask one more question, and then we'll open it up to the audience. As the U.S. national debt continues to climb past record levels, concerns about long-term fiscal sustainability are becoming harder to ignore. Given the political polarization and short-term focus that often dominates Washington, is there any real political appetite to seriously address the growing U.S. debt?
The short answer is no, unfortunately.
That's what I was worried about.
Yes. I was really encouraged when I put the pieces together ahead of the announcement that Secretary Bessent was going to be named Treasury Secretary, because some of the things that he said over the course of the last year during campaign season leaned in the direction of someone, and it's very possible that he still really cares about these things. I just haven't seen them recently. But he talked about aiming for a deficit that is 3% of GDP. That would be very, very hard to achieve. You need $6 to $7 trillion in savings to achieve that by the end of the 10-year budget window that we're looking at right now. And you have to, in order to achieve that level of savings, have to be willing to address Social Security, Medicare, Medicaid. And the president himself has said, Social Security and Medicare are off the table. I think he may be willing to look at some of the proposals for adjusting Medicaid. On Medicaid and Medicare, there are two types of spending cuts. One type is program services that a lot of times turns into just revenues to state capitals. That's a very basic way to put it. And the other is direct benefits to users. And the discussion that I've seen, and it's promising, is on how you structure payments to different states, how you structure incentives for inpatient versus outpatient care and things of that nature, where there's real savings, but it's nowhere near your $6 to $7 trillion number. The challenge with this fiscal situation is that everybody's seen it coming for more than a decade. There was a fiscal commission, a super committee even back in 2012, where there was a lot of really solid discussion and debate and real opportunities, and nothing was done, and we got a government sequester out of it, and that wasn't super positive in a lot of ways. But the closer we get to the early 2030s, when some of the trust fund for Medicare and Social Security would run out of money and there would be automatic benefit cuts, the closer we get to that, the harder it is to solve the problem. When I was first looking at even Tax Foundation's website when I was an undergrad, or looking at different publications from around the DC think tank environment, it was pretty straightforward. I mean, George W. Bush had a really pretty straightforward plan to adjust these policies to put them in a fiscally sustainable direction. And it's adjusting some benefit formulas, adjusting some eligibility criteria. But where we are right now, you almost have to tell people, we're going to cut your benefits in order to save the programs. And if politicians aren't willing to say that, and I have not heard a politician who has put those talking points together in that way, then you're just kind of ignoring the issue.
Well, I apologize for leaving it on that note, but I would like to open it up to the audience. So if anybody has a question for Daniel, I think we have a microphone there we go, there's Steve.
What is the benefit of extending this tax cut, which will put us an additional $4 to $5 trillion in debt?
That's a great question. So the benefit is kind of the opposite of the way we score policy. So if we are already seeing economic drag from the tariffs, then the policies that are being debated to extend what we have right now could offset significant portions of the economic drag from the tariffs. Now, you could immediately say, well, tax policy might be long-term, the tariffs might be temporary, so you're offsetting economic drag that's going to disappear when Trump changes his mind. The way I would structure the policy, if I were king for a day or whatever, I would not extend the policies as they are. I would try as much as possible to keep the rates and brackets the same, but expand the tax base, especially on the individual side, to make up for a lot of that revenue. We leave, and different people would frame this differently, but I'm going to say we leave on the table trillions of dollars in revenue every year because of the way we define income. And there is double exempt income in our system right now, particularly as it relates to employer provided benefits. So an employer, when they provide benefits to their employee, they get a deduction, and then the employee does not have to claim that benefit as income. And this has been in the tax code since right after World War II. And the problem with that is that you require then higher tax rates to earn the government the same amount of revenue as you could expand the tax base and keep those rates lower or lower them further. And that's one of the things that I would do to make the fiscal cost a little easier to bear. Another thing that I would do is I would say, okay, let's make these individual tax cuts. Let's extend them through the end of the current presidential term. Business tax cuts, businesses need a lot more certainty than individual families. So let's try to make as much of that permanent as possible. And then let's try to keep the cost down by making some of these other individual tax cuts temporary and subject to the next election. So that's how I'd square that circle. But the justification you're going to see from Capitol Hill is, well, we need tax cuts because we need to save the economy.
Could you speak more to the endowment excise tax? And I ask that as somebody who's on the board of a college with a $3 billion endowment. You said you think it's fairly certain the tax will increase. Do you have a sense of how much? Is 10% a number I've heard? Is that in the ballpark?
I was going to say a number higher than that, unfortunately. So the proposals we've seen, I've seen a 15% proposal. I've seen a 21% proposal to match the U.S. corporate rate. And I'm not, the thing that's not clear to me in the conversations I've had with policymakers about this because they haven't given me straight answers, is whether the guardrails on the current endowment excise tax will come off. Currently, it's an endowment per student calculation, which still hits some smaller endowments. But I think the rate will go up. It's possible that some of those limits on the applicability will also be loosened. So
10 to 20% might be the
I think so. Yes.
Yeah. Thank you.
You're welcome.
No, thanks.
Now, one of the interesting, and this is a little academic, one of the interesting things about this, are people familiar with the Laffer curve? That there's, at one rate, at 100% you raise zero revenue, at 0% you raise zero revenue. There's reaction functions to all sorts of tax policies. You raise a tax, something's going to change. If you raise the endowment tax, people are going to give gifts differently, and there's going to be a shift in the way in endowments function. I have a colleague who used to work at a university and is friends with some of the folks on the fundraising team for that university, and they have already told my colleague, hey, we've got 4 or 5 different plans in place depending on where this goes. I don't know what those plans are. I would love to share them with you, but there's reaction functions that will be seen, and we will see them potentially relatively quickly. There's the excise tax on stock buybacks that's in place. There are some companies that were like, yeah, we don't have to do stock buybacks. So for them, it's no additional tax that they pay.
Any other questions? Where's Steve?
I'm going to send that
Oh, yeah.
mic over. I think I can speak loud.
Okay, sounds good.
So in the recent times, I've heard that there was alarm because of the reaction to the tariffs and uncertainty about a decline in the value of the dollar. And the suggestion was that the U.S. dollar may lose its status as the preferred currency around the country. Could you explain a little bit more about how that comes about?
Yes. So one of the reasons that the dollar is the world's reserve currency is because people see the U.S. as a very safe place to invest. And the U.S. policy is, despite our political challenges and differences over the years, the U.S. is a pretty stable country for you to have investment. There's also demand for U.S. dollars that comes along with our trade deficit. If we are buying a lot more stuff than we're selling, people overseas will have more dollars. But the approach that's being taken right now, and I see this a little bit in the way that the Treasury Secretary is talking about this policy, and a little bit in the way the chairman of the Council of Economic Advisors is talking about this, is that they see, instead of the US dollar as a reserve currency, as a dominant currency, as being a benefit to us, they see it as a burden. That if the US dollar wasn't so popular around the world and so useful, then Congress would have to take these decisions on our debt and deficits much more seriously. And maybe we wouldn't be running these significant trade deficits. Maybe we wouldn't be running these budget deficits. But we have given ourselves kind of too much comfort in having the dollar as a reserve currency. So they are, in some ways, actively trying to devalue the currency through policies. Now, it's not devaluing the currency through money printing, which is a pretty easy way to devalue your currency, but devaluing the currency through policy uncertainty and through higher tariffs. And I do not see this working out well. I see this as a recipe for near-term economic damage and long-term loss to the U.S. of one of its bigger leverage points in the world stage. One of the things after Russia invaded Ukraine, the U.S. was able to act very quickly to put in economic sanctions that weren't 100% effective, but they were effective to the extent that the dollar was the world's currency, and we could stop as many opportunities of using the dollar for supporting Russia's war effort. The logic that the administration is using runs counter to that. They don't see that as actually a benefit anymore. Or maybe these individuals in the administration never believed that was a benefit, and instead are focused on the U.S. being much more self-sufficient on the trade policy, much more fiscally responsible on tax and spending, and they think in the long run that's a benefit, and I would just fundamentally disagree with that.
If one of the ideas behind tariffs is to bring manufacturing back to the U.S., do we have a labor pool that can support that, an expansion of manufacturing in the short to medium term, both in terms of the size of the pool and the education and training of the pool?
It depends on how quickly that adjustment happens. I've seen a real divide in the administration's reshoring policy and their immigration policy. The U.S. benefits in a lot of ways from a healthy immigration policy, and we haven't had a healthy immigration policy for decades. There was bipartisan concern in the early 2010s that ran into opposition in the House of Representatives, but the immigration policy, I think, runs counter to this objective of reshoring. Now, I say that having grown up in South Carolina, which has become a manufacturing powerhouse, that the South has really benefited over the course of time from huge investments in labor force development and huge investments from multinationals, foreign multinationals, putting in manufacturing and upskilling the workforce and things of that nature. But that's happened over decades. I think Peter Navarro talked about the BMW plant in South Carolina recently, and that's 20 minutes from where I grew up. And he was talking about that as like, that's a negative. And it was really hard for me to connect his message on that to their desire to reshore stuff, because that's what reshoring stuff looks like in my mind. And there's a lot of workforce development. It's possible that with a lot of the automation that we've seen in manufacturing, that the labor pool is sufficient and the immigration policy doesn't matter as much. But I think especially for high-tech manufacturing and some of the upskilling, that a better immigration policy could help smooth over that transition. If that transition, and this is the rosy scenario when in which that transition actually happens.
Thank you very much, Daniel, for being here today and for all the thoughtful energy to the conversation. Appreciate it.
Thank you. Thank you.
One of the things that we value most here at Westover is creating space for meaningful dialogue like we had here today. And if something you heard sparked a question, I know Daniel will be sticking around afterwards. And so please enjoy some beverages and some food and continue the conversation. All right. Thank you very much, everyone, for being here today.